Good afternoon, ladies and gentlemen, and welcome to the RICARDO PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from RICARDO PLC. Graham, good afternoon, sir.
Thanks, Jake, and welcome everybody to a presentation focusing on the results for RICARDO of 23-24. Just before we start, as is usual in these types of presentations, please take note of the disclaimer statement. Also, before we launch into the results for the year and the agenda, look, I thought it would be probably wise, given some on this call may not have a complete visibility of the journey that RICARDO is on and what we're focused on. But we are a global consultancy focused on the decarbonisation and environmental transition of services with an engineering focus and also at the intersect of transportation, energy infrastructure and policy globally. So we operate in 23 countries with about 3,000 people, focusing on 8 core markets. 4 of which, as you see here are in blue, are in transport markets. So automotive is anything from motorcycle and automotive all the way through to commercial vehicles, off-road and on-road. Maritime, as it would suggest, is anything with a propeller and moves from a water perspective, but also increasingly at the ports and the port tractors and mobility requirements at a port. Rail and mass transit, again, as you would expect for rail, and again, looking increasingly at alternative propulsion solutions and also aerospace and defence. We also focus on energy utility, so that's looking at the energy infrastructure and the requirements and transition from traditional fossil fuels to renewables and the storage implications and grid infrastructure. Increasingly supporting industrial and manufacturing customers through their own decarbonisation journeys. And then finally into government and public sector. That can be both at the state level and also a geographic level. And small at the moment, but financial services is also another core area where, again, we see an increasing focus on investors and debt providers to focus on decarbonised investments. In terms of our history, we were founded over 100 years or so ago by our founder, Sir Harry Ricardo. And again, he focused on maximising efficiency and eliminating waste. And again, that remains core to how we operate today. In terms of the agenda for today, look, I'll just give some headlines on the results for the year. I'll then hand over to Judith to take us through the financial results in a bit more detail. I'll then give a bit more colour on the strategy and the market that we are operating in at the moment before closing remarks and then open up for questions. So we continue to deliver on our financial commitments made in our 5-year strategy presented in May 2022. This was delivered by a very strong second half overall for the group and a return to profit in A&I, following the actions taken to create a more flexible operating model. This profit improvement, combined with rigorous working capital, has improved cash from operations by 96% year on year. In addition to the financial performance, we've made good progress in our strategic objectives, accelerating our operating model transformation with the centralisation of all our functional teams. We do continue to have some order variability in some of our own markets, and I'll give a bit more colour in the strategy update of what we are seeing in the short and longer term. However, we enter 24-25 with record 12-month order book and gives us confidence in delivering good profit growth next year as well. I'll now hand over to Judith to take you through a bit more of the financial detail.
Great, thanks Graham. Good afternoon everyone. I'm going to take you through the results for FY24, a period where we've seen good growth in revenue, improved profit performance in the second half and excellent cash conversion. This is our usual KPI slide and it shows the performance of the continuing underlying business on a constant currency basis. You'll see we've delivered good growth in revenue and profit, improving profit margins and strong cash performance. Our order intake of 496 million, 3% down on last year's record order intake, but our orders are exceeding our revenue and that revenue's up 9%. With improved profit performance in the second half and also actions we've taken through the year to reduce our fixed cost base in our A&I business and to centralise our enabling functions as we continue with our operating model transformation, we've seen our margins improve by 60 basis points to 8.2%. And with improved margins and good revenue growth, we've seen our underlying PBT up 13% to 30.5 million and EPS up 14%. We've had a rigorous focus on working capital management, which means our cash conversion's up to 119%. That's 50 percentage points up on last year and ahead of our 90% target. We've used that strong cash conversion and cash generation to fund acquisitions and restructuring costs in the year and reduced our net debt by just over 2 million to just under 60 million. And that's put leverage on our target of 1.25 times. We're proposing a year-end dividend of 8.9p per share to give a total dividend for the year of 12.7p. That's up 6% on last year and is in line with our dividend policy of maintaining cover of 2.5 to 3 times. It's also broadly in line with the increase in our underlying EPS before adjusting for constant currency. So as I've just said, we've seen strong revenue growth and improved operating profit margins. Our revenue's up 9%, gross profit's also up 9%, meaning we're maintaining our gross profit margins. We're continuing to control our indirect costs, which are reducing as a percentage of revenue and are now pretty much down to our target level of 20%. That's given operating profit up 17% to 38.8 million. And with that good revenue growth, improved profit performance in the second half, and that continuation to centralise our operating model means we've seen our margins improve by 60 basis points to 8.2%. Our finance costs, whilst in line with expectations, are 2.2 million up on last year. That's predominantly due to increased interest rates. We've seen our interest rates increase from just under 5% to just over 7%, driving a 1.8 million increase in our costs. And that gives profit before tax up 13% to 30.5 million. Our underlying tax charge at just under 27% is broadly in line with last year, but I do expect to see that increase towards 30% as we see increase in profits from higher tax jurisdictions such as Australia, but also because in some of the jurisdictions we operate in, I expect to see some tax rate increases in the future. And that gives profit for the period up 13% to 22.4 million. I'm about to talk to you about the performance of our individual business units, but before I do, I just want to give you a bit of a feel for how we run our business and how we're structured. We have 2 portfolios, our environment and energy transition portfolio, and that consists of 3 business units. Energy and environment, where we're a leader in sustainability consultancy, and we solve complex environmental challenges. We have a rail and mass transit business where we provide technical consulting experts in critical and complex railway systems. And then we have an emerging automotive and industrial business where we provide engineering consultancy in decarbonised propulsion design and complex integration. We then have an established mobility portfolio, again comprising 3 business units. Defence, who provides expertise in delivering integrated engineering to product assembly. We have our performance products business, who specialise in niche volume design, procurement, manufacture and assembly. And then an established A&I business, where we provide conventional propulsion design, development and production. So looking first of all at our environmental and energy transition portfolio, the performance of this portfolio has been impacted by delayed orders in our emerging A&I business, but we continue to see good growth in energy and environment and also in rail. In energy and environment, acquisitions have accelerated our growth here. Our revenue growth at 18%, of which 10% is organic. That organic growth has been driven by strong demand in policy, strategy and economics, and also in air quality and environment. However, in the second half, we did see a more subdued performance within our water practice as a result of some disruption on projects within the Middle East. As a result of that, we saw lower utilisation in that team, and that coupled with ongoing investment for growth in our EE business in total means we've seen our margins down at 17%. That gives profit growth of 11%. We enter 25 with a strong order book, and we expect to see recovery in our water business during the year. And that should enable us to continue to deliver good revenue growth and see recovery of those margins. In our rail business, we entered the year with strong order book and a good pipeline, meaning we've delivered order intake growth of 11% and revenue growth of 9%. We're seeing good growth in our core growth markets of Asia, Australia and the US on the back of recent project wins. And with that revenue growth, we're getting a bit of operational leverage, which means our margins are up a little at 11.5%, giving growth in profit of 14%. Looking forward again, we've entered the year with a good order book and a strong pipeline with good opportunities in US and Canada. So I expect this business to continue to deliver mid to high single-digit revenue growth. And again, we should see a little bit more operational leverage, just pushing those margins up again a fraction. And then finally, in our emerging A&I business, here we operate across diversified markets where we're seeing changing and evolving client needs as they manage the complexity of energy transition. That is creating some short-term volatility in our order intake, but we remain confident around the long-term potential. We also saw some delays in a couple of orders at the back end of last year. So as a result, our order intake's down on last year, and that means our revenue and profits down. We've taken action in the year to focus the business on our core growth markets and growth solutions. And this is the area where we've taken action to reduce our fixed cost base and increase our proportion of variable resources, meaning we're better able to manage that order volatility going forwards. And in a minute, I'm going to talk about the recovery we've seen in our overall A&I business, H2 compared to H1. Looking now at our established mobility portfolio, we've delivered good growth in revenue and profit, and that's been underpinned by the performance in our defence business. In defence, we've seen our orders up 54%, our revenue up over 45%, and with improving margins, we've seen our profit almost double. That's really been driven by increased volumes on a programme we've got in respect of ABS kits, where we've seen volumes ahead of our expectations. We've also got a technical consultancy business here where we've seen good growth and delivered double-digit revenue growth. Looking forwards, I do expect to see the volumes come down on that ABS programme by about 20% in FY25. We've got a finite programme there, deliverable by September 27. So expect our volumes to come down off the peak in FY24. However, I expect to see good growth still in our technical consultancy business, but overall expect our revenue and profit to be down in defence in FY25 compared to 24. In performance products, last year we had 40 million of order intake across 2 multi-year transmission programmes. If you strip those out, our underlying order intake's up around 2%. But despite that small increase in orders and an improved performance in the second half, our revenue's down on last year a fraction, and we've seen our profit and margins down. We've got 2 parts of the business here. We have a business where we produce powertrains, and that's performed well, a little down on last year, but broadly in line. And then we've got a transmissions business where we're seeing 2 programmes coming to an end and a new programme ramping up. And that's what's caused the reduced profit and revenue performance in this business overall. Looking forward, I expect to see the revenue and profit come down a little bit again in FY25 because of those programmes in the transmissions business that are ending. One ended in FY24 and the other ends during FY25. However, we have just secured a new framework agreement which should lead to a production and assembly programme commencing in FY28. And then in our established A&I business, We've seen our order intake down overall, but we saw improved order intake in the second half on the back of continued demand for our services here. As a result of that increase in order intake, our revenue's up 6%, and our profits our loss has reduced on last year, and we moved from a loss in the first half to a small profit in H2. So looking now at the recovery of that A&I business in total, overall our order intake's down fractionally in H2 compared to H1, but we've seen increased order intake in our established business, with some reduction in our emerging business as a result of delayed client orders. With improving order intake in the established business, our revenue's up H2 compared to H1, and we deliver flat revenue in the emerging business. As I said earlier, we've taken actions to reduce our fixed cost base here, meaning our costs overall have reduced, particularly in our emerging business. And so with flat revenue and reducing costs, we've seen the emerging business go from a loss in H1 to a profit in the second half. And in the established business, with increasing revenue and good cost control, again, we've gone from a loss in H1 to just above break even in the second half. So overall, the A&I business went from a 5 million loss in H1 to broadly 5 million profit in the second half. Looking forward, the order book in this area is down a little on last year in total, but the amount deliverable in the next 12 months is broadly in line. So that, coupled with the actions we've taken to reduce our fixed cost base, means we believe we're now able to deliver a sustainable profit going forwards. We incurred 26.2 million of specific adjusting items in the year as we continue with portfolio transition and our operating model transformation. On portfolio transition, we've incurred 17 million of costs. That's around amortization of acquired intangibles. It's because we paid maximum earn-outs on prior year acquisitions, and we've spent some money on some strategic projects as we continue to investigate M&A opportunities. And that resulted in a cash outflow of just over 15 million. On reorganisation costs, we've incurred 8.4 million of P&L charge there, of which 7.2 million related to our operating model transformation, where we've centralised our enabling functions and we've reduced our fixed cost base within the A&I business. You'll see there, though, the cash outflows are 5.4 million, so we've still got just around 1.5 million of cash to come in FY25. And looking now at our cash performance, as Graham said, we've seen a 96% increase in our cash from operations. That's come from a rigorous focus on working capital management. I mean, our cash conversion is up at 119%, up over 50 percentage points on last year and ahead of our 90% target. That's partly because we collected some delayed receipts from the back end of last year, but it's mainly around a focus on cash collections and a reduction in our debtor days. I'm pleased with the progress we've made to date, but there is more for us to do. Within our PP and defence businesses, we're going to need to manage our inventory levels as we see programmes ramping up and down in volumes. And within our consultancy businesses, we're now going to focus on uninvoiced balances and improve our invoicing profile on projects. You'll see our capital expenditures up a little on last year, and we're continuing to see a trend where we're moving away from physical assets to investment in intangible development assets as we create offerings and solutions, particularly in energy transition and also in the digital space. And overall, our cash before acquisitions and restructurings is just under 23 million. That's up 27 million on last year. And as you'll see, with the sale and leaseback of a property, Insurham has more than funded our acquisition and restructuring costs, meaning our net debt's reduced by 2.5 million to 59.6 million. And with reducing debt and good profit performance, that's meant our leverage has reduced from just over 1.4 times last year to our target level of 1.25 times. That gives good headroom on our bank leverage limit of 3 times. We've got a 150 million RCF facility, of which 47 million at the end of the year was undrawn, and we had around 43 million of cash, meaning we've got good headroom on our facilities. And then looking forward, we've got an order book of 396 million. That's up just 1 million on last year's record order book. But more importantly, we've got a record order book deliverable within the next 12 months at circa 260 million. That's up around 10 million on last year. We're seeing good growth in our order book in energy and environment, in rail and also in defence. In PP, as you would expect, as we work our multi-year programmes, we're seeing our order book reduce. And then, as I said earlier, in A&I, our overall order book's down, but the amount deliverable in the next 12 months is broadly in line with last year. So that strong order book with a good pipeline visibility gives us confidence as we go into FY25. And so to summarise and look forward, robust order book, good pipeline visibility gives us confidence on FY25 revenue. During FY24, we saw improved profit performance in the second half. We saw improving margins as a result of the operating model transformation. And that meant our underlying operating profit increased by 5.6 million. That means we're on track to deliver our ambition of doubling our underlying operating profit in the 5 years to FY27. With that rigorous focus on working capital, our leverage is on target now as a result of a reduction in our net debt. And then we will expect to see our debt increase. As I mentioned, we've won and secured that framework agreement within our performance products business. So we're going to have to start to invest now to create that long-term value by investing in property and equipment through FY25 and 26. And then finally, our focus remains on delivering strong organic growth across the business in FY25. And with that, I'm going to hand back to Graham to talk about where the organic growth is coming from.
Thank you, Judith. So we launched a 5-year strategy that we presented in May of 2022. And at that, we created a 5-year plan with milestone activities each year enabling the tracking of our progress. In 23-24 has been a year of material strategic change in the ways of working in the organisation. As we look forward into 24-25, the level of change of the organisation will be much less, enabling us to focus on consistent execution and accelerating growth and profitability in the coming years. Going a level deeper in the change delivered in 23-24, we're very excited about the digital platform and the first application launched in July this year. The platform has been designed and developed to enable high levels of flexibility, interactive visual displays of information, and positive customer experience for end users. Equally important, it is also built leveraging standard modular forms that means future applications can be added to the platform much faster. Within geographic expansion, we are pleased with the progress made, particularly in our target regions of North America, Australia, and the Middle East. In the US, we've developed some strategic partnerships, particularly in rail and EE, that will accelerate access to new markets. An example of this is partnering with Network Rail Consulting in the delivery of the California High-Speed Rail project. Judith also mentioned we have signed a new framework agreement within Performance Products. This is a very significant program that will be the largest single annual revenue program delivered by Performance Products. Strategically for PP, this also diversifies the portfolio as the production and assembly is outside of the high-performance automotive sector and will also utilise our facilities in both the UK and in North America. In addition, as highlighted by Judith, over the past year, we've been active in our portfolio transition and continue to seek partnerships that meet our M&A approach and criteria. We currently have a strong pipeline of M&A opportunities and expect to continue to focus on M&A to support us in accelerating our transformation in 24-25. We've talked extensively about the continued recovery in A&I and the creation of the flexible operating model. This has enabled the return to profit in A&I and the contribution to the group's second half profit. The last 3 months for orders in A&I were behind expectation, with a couple of orders not converting in the year, one of which has since been won. We remain confident in our strategy to diversify the industry mix of transport customers, helping them with all the potential emerging propulsion options and acting as their portfolio transition partner. However, we still have some work to do to ensure a more consistent flow of order intake. I'll talk shortly about some of the market drivers we are seeing in A&I. Finally, the acceleration of aligning all our functional teams across the group. This has always been planned to support the reduction of indirect costs to 20% of revenue, but we have accelerated this to support the delivery of 23-24 financial commitments. It will also help accelerate our orders and revenue growth with more consistent sales processes and insight on the sales pipeline. In addition, we have a key focus on talent development and consistent career path opportunities across the group. As you will see in a couple of slides' time, it is also vital in how we create our One Ricardo culture. To give a bit of colour on the first digital application, it is, we believe, the leading digital electricity pricing model available. We believe it is leading for a few reasons, and all stemming from the acquisition of E3M 18 months ago. Firstly, it is built on the Prime's IEM model, an industry-leading model which has been used by the EU as the reference model for electricity pricing for the last 20 plus years. Secondly, it's been developed by the creators of GEM-E3, rated the top tool for industrial transformation analysis by Renewable and Sustainable Energy Reviews. In addition, the digital application is entirely flexible, allowing the user to adjust multiple parameters and create bespoke analysis for their specific needs. Finally, different to other digital tools and reports, it gives access to the underlying source data, meaning the user of the tool has full control of the analysis. The E3M services have been materially sold to government customers, and the digital application allows us to expand our offering to more corporate customers. We've been piloting the tool with beta customers in Greece, and we'll be looking to scale the solution to utilities, banks, and heavy users of electricity across Europe. Strategically, this is at the core of the Ricardo focus area, providing expertise in digital solutions to support investment in energy infrastructure to enable energy transition. We believe that by establishing these digital tools, we'll also accelerate the take-up of our complementary strategic advisory capabilities. We currently have digital and strategic revenues of around 5% of total group revenues. As shared at the Capital Markets Day in May 2023, we expect this to increase to more than 10% over the next few years, with margins in excess of 20%. This will therefore be a significant accelerator of our margin over time as we increase the mix. Before we look at the priorities for Ricardo in 24-25, I wanted to take a few minutes to share a view of the markets in which we operate. These market themes create potential challenges and complexity of energy transition in the short term, but reinforce the need for the solutions Ricardo provides for the longer term. The first theme is that the energy transition is complex, and the economics and timing of change for energy supply and energy offtake need to align for many decision makers. If the energy supply side cannot see the offtake, they will not invest in renewables, storage, and the infrastructure required. If the off-takers cannot see the provision of energy in the right location at the right price, they'll not create transport or industrial conversions to leverage the decarbonised energy supply. Ricardo is therefore well positioned in its expertise across government policy, energy infrastructure, and transport operators to support many stakeholders with the understanding and the solutions to unlock their interdependencies. The second theme is that more than half the world's population in 60 countries in 2024 are having elections, which has created some delay or uncertainty in the environmental policy at both the national and state level. We believe this will return to more normal levels post-elections. However, one of the trends we are seeing is that governments of all political persuasions are grappling with the economic challenges presented by the energy transition. This is leading them to develop policies for cross-border international carbon tariffs. With our blend of carbon emissions, policy and economics advisory, we are ideally placed to support governments globally in this area. The next theme is that the propulsion mix and cost of transition is complex and uncertain. This is applicable to all modes of transport depending on geography, energy supply, or vehicle performance requirements. This is leading to more multi-phase projects that don't always complete all stages. Customers are using stage gates to reassess the business case for different solutions, which has led to some projects being either deferred or cancelled before completion of the project. Again, Ricardo is well placed in its ability to support the multiple potential strategic options available to customers with its technology agnostic solutions, whether it be a need for hybrid, sustainable fuels, hydrogen fuel cell, or electrification capability. Our progress in creating a more flexible resourcing model internally means we can also deal more effectively with order fluctuations if projects are cancelled or deferred. Finally, the cost of energy transition globally is estimated at 1.7 trillion in 2023. To align with the Paris Agreement target of 1.5 degree temperature rise, Bloomberg estimates an average annual spend of 4.8 trillion would be required for the rest of the decade, with further increases in the 2030s and 2040s. The numbers are clearly huge, and it creates a massive opportunity to support the Ricardo growth. However, it also represents a real global affordability challenge to enable the transition. And most days at the moment, we see reports of governments or corporates scaling back investment commitments. We have been impacted directly in our water business, with large contracts being cancelled or deferred at short notice, impacting Q4 performance, as mentioned by Judith. With Ricardo's investment in repeatable digital solutions, we believe we can support our customers with more cost-effective, faster routes to energy transition and take advantage of the huge global investments over the next 20 to 30 years. Having had a year of material strategic change in 23-24, 24-25 is all about execution and implementation of the new ways of working. Core to this is organic growth and converting our strategic focus areas of portfolio, industry, and geographic expansion. We're increasingly sophisticated in navigating the complexity of the megatrends discussed previously and taking advantage of the opportunities for Ricardo. This, we believe, will help us to create greater consistency in order intake and therefore organic revenue growth. To support the scaling of the environmental and energy transition portfolio, we also have ambitions to be more active in M&A in 24-25. The enablers of this growth are in establishing a collaborative and engaged culture with a One Ricardo mindset. We've made great progress in breaking down the silos of different business units and functions over the last couple of years. We lack scale in these smaller units and will therefore continue to focus on how we can offer greater value to our customers and scale faster together. With the changes in the operating model, we'll also focus on optimizing operational efficiency. This includes the alignment of processes and best practice across things like resource management, learning and development, facilities, procurement, billing, and collections. Finally, we are a people business, and our teams are passionate about working for a purpose-led organization. This is important for our teams, our customers, and the communities in which we work. We've established a more structured approach to support our circa 3,000 colleagues engaged in activities across the group. As a company of engineers, scientists, and technologists, Ricardo has always been a strong supporter of STEM initiatives within our communities and charity work. In 23-24, we actively managed our Ricardo Group charity and volunteering program, which provides all Ricardo employees with voluntary hours per year to support selected STEM partner organisations. These activities create energy and motivation for our teams, but also have a direct impact on our business. The voluntary churn we have achieved is below many industry peers at circa 13% for the group, meaning we focus our recruitment spend on growing the business rather than replacing our talent. We also want to continue to create a funnel of low-cost STEM talent from the schools, universities, and STEM partner organisations that we work with. So to finish with a few closing remarks, we've continued to deliver on our financial commitments. This includes a strong second half of the group, A&I returning to profitability, and strong cash generation to fund successful integration of our latest acquisitions. In addition to the financial commitments, we made great progress in our strategic implementation. We've launched the digital platform, signed the value accretive framework agreement in performance products, and been active in M&A, all of which will support long-term profitable growth. The cultural alignment of One Ricardo, the flexible resourcing of A&I, and the functional operating model across the group will make our teams more efficient in delivering on our ambition. And finally, we are confident to continue consistent delivery in 24-25. Our record 12-month order backlog, good pipeline visibility, and our organic growth focus gives confidence in delivering our 24-25 financial commitments. In addition, our consistent strategic priorities of developing digital applications, optimizing the efficiencies of our operating model, and using M&A to accelerate our growth would enable us to continue to make long-term strategic progress. So in summary, we're consistently delivering on our short-term performance and delivering on the strategic change to build confidence in 24-25 and our long-term strategic ambition. So thank you for listening. I'll now open up for a few questions. Jacob.
Perfect. Absolutely. If I may just jump back in there, Graham, Judith, that's great. And thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Graham, Judith, as you can see there, we have received a number of questions throughout your presentation this afternoon, and thank you to all of those on the call for taking the time to submit their questions. But guys, at this point, if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thanks, Jake. So look, the first question is around the order drop of 5%. Look, I mean, I think and how are we planning on dealing with the order fluctuations? Look at the group level, as we explained, some of that is a result of one-off, large project in particularly performance products. And that has an impact on the year-on-year comparisons. But look, as we talked about we are seeing some fluctuations, particularly in the A&I business. As we talked about, we've done quite a bit of work internally around reducing the fixed cost base to what we believe is the sort of minimum viable footprint of our fixed cost base. And that means that we can also scale up and down with variable resourcing to support fluctuations in demand that we've got. So look, that operating model in A&I is where we're seeing the most fluctuations, and we believe that with that flexible operating model, we're best placed to enable us to manage that situation in A&I. Next question was mentioned the shift in services to solutions, focus on consulting and digital. What competitive advantages do you think Ricardo holds in this space? So look, the core focus for us is around the link between policy, transport, and energy infrastructure. And across all of our different projects, we capture data specific to the efficiency or performance, particularly in our performance in our transport space. But we also capture lots of data from a water perspective, from an energy infrastructure perspective, from an air quality perspective. And all of these things are actually interlinked in terms of the drivers of how the data fits together. So we believe that both through our own data, some use of open access data from our customers, we can provide differentiated insight across policy, transport, and energy infrastructure. So an example of that would be we've done some work around the air quality implications of brake and tyre wear, combining our air quality expertise with our transport and testing capability that's actually feeding policy work into the EU to drive health policy and the implications of a transition to EVs. Typically, EVs are heavier as a result of the battery, and therefore higher tyre wear, higher brake wear. So that has a direct impact on air quality and health implications. So that's a good example where we believe we can bring the data and the insight together to create differentiated insight. Next question is around the new performance framework. Does each lot of the framework have to be bid competitively? No is the easy answer to this one. Again, this is a combined project that will be actually designed and developed within our A&I business in terms of the consulting and creation of the very complex unit that will be delivered. And then ultimately our performance product team will do the supplier management, the new product implementation, creation of the assembly line, and then ultimately own or be accountable for the assembly of the units in a couple of years' time. The key driver here is not that it goes to any competitive tender, but more about the milestones as we go through the design, getting through A sample, prototyping, B samples, and then ultimately into production. So that will be the building confidence that we get as we go through the next couple of years. But look, there's also increasing confidence as we go through, because the customer will also be investing quite significantly in new development from a supplier tooling perspective, and ultimately is also going to purchase back the assembly tooling as well. So again, the customer is committed. If for whatever reason they were to cancel the project, that we would be reimbursed for any costs incurred. So next question, can you talk about the potential and scope for wireless in the defence business? So look, good question. Look, about 80% of our revenue in the year that we've just achieved, the very strong results was in the ABS program. So that gives us 3-year visibility to complete the retrofit of the Humvee for brake discs. What we've also been doing in parallel, that's about 20% of the revenue, is looking at developing new programs, new campaigns as we call them, about the potential additional programs that will hopefully replace the ABS program. One of those examples is around a wireless solution where infantry will have a wireless intercom connection back to the vehicle as they go on patrol, and that is again a program where we will create bespoke software, but also leverage leading suppliers in wireless technology, and make sure that they have the right level of security clearance and procurement requirements for the DoD. That's one of the programs. It's been one that has been in development for the last couple of years. It continues to progress well. The first prototyping on the first vehicle platform was done about 6 months ago, and there's further conversation now about what other platforms it would go on to. So that's just one of the programs. There are others around digital logbooks, for example, which will look to create digital tracking of maintenance records for vehicles in the DoD. So again, there are a number of projects. Question on if a project is cancelled, do you have a cancellation fee applicable in your terms and conditions? So look, typically we will have cancellation at different stage gates, which will require a level of specified scope, and then on successful completion of the project, increasingly that is looked at from a technical perspective, and we're very good at creating the technical solutions and getting to those stage gates. But as I mentioned in the strategy update, increasingly what we're seeing is that customers are using those stage gates to reassess the business cases to enable them to confirm whether they want to go to the next step or not. So these stage gates are effectively where new work is, a new scope is signed on for the next phase. And as I mentioned, that we are seeing some examples where projects aren't continued, but we're not exposed on particular work that we've already done. We complete the stage gate, and that then creates the catalyst for the next one. Okay, regarding emerging A&I, what's the reason for such a significant decrease in order book and revenues? How is the quarter to date in terms of volume? So look, as I was mentioning, the variability we are seeing in all of our transport markets. And as I shared at the start of the presentation, we cover everything from passenger car, motorcycle, small commercial vehicles, large commercial vehicles up to Class 8, off-road construction vehicles, marine vessels, ocean-going, small barge type vessels, pleasure boats. So the vast array of different mobility solutions. Every one of these solutions is going through an energy transition from combustion engine to something else in terms of a decarbonised solution. What we're seeing is two things. The first is that actually the solution between for different mobility or transport solutions may have a couple of different options. So, for example, commercial vehicles at the heavier end is likely to be either electric vehicle or fuel cell, depending on the routes and depending on the energy infrastructure. Many operators are going through that business casing and trialing those two options. Equally for marine, the option is likely to be sustainable fuels, so methanol, ammonia, hydrogen potentially, or fuel cell. Again, different options. So again, they are trialing and prototyping different solutions, maybe even dual fuel through the next few periods. So our customers are trialing different solutions, which means that actually they can stop and defer projects based on the stage gate and the solutions that they are offering. The second thing that we are seeing is that generally, and again, this is a general statement, but the energy decarbonisation is probably shifting a little bit to the right. What that means is that some of the startup type of customers that might have been investing a couple of years ago with higher interest rates, more challenging economic cycles, are perhaps more cautious. Again, they are dependent on funding themselves. Therefore, the levels of investment are a little lower. That has slowed up. Secondly, some of the bigger operators, perhaps with lower competition, perhaps with lower government policy and shifting to the right in the UK, the most obvious one is the passenger car, going out 5 years to 2035. Again, most countries are pushing that boundary to the right. There is a shift again in the shift from some of the bigger operators as well, where again there isn't that drive to shift. Now, again, that creates some fluctuation in the short term, but equally, again, our technology agnostic and our spread and our diversification in the markets is why we think in the longer term we can smooth out some of this fluctuation. Next question was around water advisory. How dependent in the sector activity on government spending? Budgets are tight, not least in the UK. Does this impact your view on the recovery in activity? Look, we bought a couple of water businesses last year because, again, we see very significant long-term trend in water advisory work globally over the next number of years. The specific challenge that we had was as a result of a cancellation of a fairly significant individual project in the Middle East, in Saudi, and we believe that is a one-off project. Again, I won't go into too much detail here because of the customer confidentiality, but look, that we believe is a one-off project. We are now building back pipeline and seeing that pipeline build back quite well. And proof point there is that we won quite a significant project a few weeks ago. That again gives us confidence that this is the market is there. In terms of the long-term advisory development, and again there's reference here in the UK, but it's the same in many of the markets that we operate. The advisory services required for aging energy, water infrastructure. Again, in the UK, that's well publicised with the overflow and sewage implications on waterways. But that challenge is actually in many of the European and Western sewage implications, aging infrastructure, therefore the need for investment and prioritization of that investment is very significant. Equally, look, we're seeing increased weather patterns, whether it be drought or flooding implications. Many of us will remember just a couple of months ago seeing Dubai underwater and the implications of flood risk there. We see wildfires in many states in the US and Australia on a consistent basis. So this weather extreme, where how do you manage and mitigate against differing weather patterns and advising on these for all sorts of different customer bases. Agriculture, we work with land operators in water around what does the yield look like in various parts of areas where we see climate change happening. Therefore, there'll be more drought in the longer term. We work with increasingly looking at the risk around data centers and the water dependency for cooling. We're working with state governments around, again, how do we manage and mitigate for flood risk. So look, simple answer, given lots of examples, but look, water we see as a very strategic long-term asset and value for us. Last question, I think we've got, when will your ERP system implementation be completed, if not completed already? So look, we have some ERP exploration work that we've done in the last year or so. We've had one of our business units change to a localized solution that helped them operationalize and manage inventory and stock management. So it was in our performance products business. But look, actually, we haven't done a huge amount of ERP development in the last couple of years. We've been exploring options. But again, what we want to do over time is simplify the operating model and consistency of how we operate. And then we'll look at ERP and systems consolidation at a future date. But again, our focus actually is more from an external market focus, really driving growth from an organic perspective. Look, we're driving the efficiency and the process changes internally. But again, my experience of having done a few of these ERP systems in my past, actually getting the operating model, the accountability, the process aligned first before you then create lots of investment on the system. So look, we haven't spent or invested huge amounts of time and effort so far in ERP. So I think that answers the questions on the call.
Absolutely. Graham, Judith, if I may just jump back in there. Thank you very much indeed for being so generous of your time there and addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Graham, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Thanks, Jake. So look, hopefully what we've given you today is, for those of you who are new to the story, just a brief overview of what we're doing, but also for those who've been on the journey and hearing over the last couple of years. Look, we continue to deliver on both the financial commitments and the strategic journey that we are embarking on or have embarked on, and the commitment to double operating profit from an organic perspective over the next 3 years or in the 5-year period. So we're on track to do that. We're making good strategic progress and confident on the outlook as we go forward as well. So thank you for your time today. Hopefully you found it informative and look forward to speaking again soon. Thank you.
Perfect, Graham. That's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Ricardo PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.